right. Here again with Guy Riccardi, we're going to be talking a little bit about what I call the retirement shift. And it's really the shift in mindset and strategy that really comes into play as you're getting closer to retirement. And then when you're in retirement, when you first start out, whether you're working or you're putting money away, building it in mutual funds or putting it in no load funds, to just index funds to grow is great. But then as you get closer to retirement, you start thinking, man, maybe I need someone to help me with this. Am I on track? Am I going to be the right way? I still need gains, but I don't want to take big losses. These are all things that I hear often, and I'm sure you do too, Guy. And then the other factor comes in is, okay, well, now I need to start taking income. I think currently Morningstar's safe withdrawal rate is around 4%. I know it's been as low as like under 3%. But it's been steady around 4 for a while, where yet when our clients are taking income, we can safely generate about 6% income just because of how that's being taken care of. And so I think there's a shift in multiple things as you're getting closer to retirement. A lot of it we've talked about with just risk management and why we use why we use individual stocks versus mutual funds and things like that. But Guy, if you want to expound on the topic a little bit more, love to hear your thoughts too.
Yeah, well, obviously, yeah, like you said, it is a big shift when you're going into retirement because essentially you're coming out of that accumulation mode, and not only coming out of the accumulation mode where you're no longer saving, but it's flipping all the way over to you're now going into a distribution mode and actually having to rely on the assets. So what the big shift on that, it becomes more important with a little bit of the volatility control, because once you're in that distribution mode, you're going to have to be taking those distributions given all different types of markets. When you're still in the accumulation mode, the volatility does not matter quite as much, as long as you're not taking significant principal risk in terms of putting it into things that could lose all its value or go to zero, but you're only dealing with price volatility risk. It's almost a blessing over the course of time to be getting those big downswings, because you're still continually saving into that. So when you're getting a big down market, all those savings that you're putting in for that year are essentially buying things at good discounted prices.
Mhm.
Um, Now that obviously switches then when you're taking money out of the investments. So it becomes a little more crucial to be mitigating that volatility, so that when you are seeing those big down markets and you are now relying and you're taking from the accounts, it's taking from income that's being generated, but then, also we talk about non-correlated assets, and, given all different types of market environments, there's usually always something that's gaining inflows or doing well, because of that concept that money doesn't necessarily disappear. It just flows from one thing to the other. Sometimes it's flowing to cash, but oftentimes, other times it's in 2023, it was inflowing into inflation protected stocks and things like that. So having active management to kind of navigate through those markets becomes crucial when you're taking those distributions, because it ensures that you're selling the right things at the right time. In a poor market, you're selling the things that are up that year to help cover the distributions, rather than, if you're just letting it ride and kind of going all the way down with a bad market, it means you might have to be selling some things at levels you don't want to be selling them to get your distributions if you're not managing it properly. So that's the big switch that happens from, when you're working and in that accumulation mode until becoming retired and now in the distribution mode.
Yeah, and I think, even a few years before you might get to that distribution, there's this thought on, I don't want to lose everything, but I still want to get some gains, right? And that's where I think it becomes crucial with the risk management that, we talked about a little bit more when we talked about individual stocks and risk management. But you just hit on, it does become a little bit more crucial, because if you don't have some risk management in there, and you're just relying on, a pooled strategy or a 401k or whatever, they don't care. They're not thinking about you and when you're retiring as they're managing that portfolio. Where if you're building it out and you're working with us or, advisors that are saying, hey, we know you're going to be retiring next year. that we know what kind of income you're going to need, and risk management. You're not giving up all the upside potential, but we are managing for that, some of that downside loss too. So you don't have to write it down. And I think that's why a lot of people want to start, if you haven't been already, all of a sudden becomes more of a thought is I need someone to help me with this as we get a little closer to retirement, because there's a lot more complexities than just putting it in and let it grow up. As Guy mentioned, you're starting to rely on it, or when you know you're going to need to rely on it, then it becomes having someone who's knows what they're doing, and that's their job to look after and make sure you, one, will be able to retire, and two, be able to continue that income. So anyway, thanks for sharing, Guy. I appreciate it. And if that's your spot and you're close to retirement, or you're going to be in retirement and want to know how that's going to work, I know one of the best reviews I just did, Guy, with somebody not too long ago. They retired a few years ago, which it's been a rocky couple of years, right? And they're taking out a high amount for income, pushing actually a little over that 6% that we might recommend, because that's what they need. He's like, hey, I'm taking the money out and my money's still growing. I can't be more than happy, So that's where that's why it's important. And if you were just taking it out of somewhere else, more than likely your account might be down. So managing to be able to get that income and still see some returns. Again, that's where taking the money out when you're needing income from the right place at the right time becomes highly critical to still see those returns. So anyway,
Absolutely.
so let us know if you have questions on that. Thanks again, Guy, for sharing.
Yeah.